and I would be shocked if this wasn't true, but on video number 5, I explained the process of bringing your stop up to break even. So if, say, for example, you were going to go long down here, well, when the market's moved up 40 or 50 pips, there's no reason to keep your stop way down here. Once you've taken partial profit, you really should move your stop up to break even, because there's no reason to risk the extra amount. I mean, let's think about it this way. Get this pen working. If you have if your position moves up from, we'll say, 200 to 230, and you've taken partial profit, if your original stop was, say, 35 pips, you see your risk is no longer just the 35 pips. Your risk is actually 65 pips, because the market is trading 30 pips higher. So there's no reason to take an actual losing position on this. So when I take a partial profit, whenever I take a partial profit, I always move my stop to break even, maybe even a little bit better, because there's no reason to give profits back to the marketplace. Okay, now this one, Dick writes, and this one I am a little bit aggravated with. He says, Mac, can you do the math for me, please? I think you have unreasonable expectations. Given your expectancy formula, going with your first example, win-loss 60-40, average win 75, average loss 33, results in a positive expectancy of 31.8. I understand this, all the other examples, no problem there. Now this is the problem this is the area that I have a problem with. And, you know, Dick, what I would challenge you to do is do the work for yourself. Okay, and what really set me off was Dick says, hint, it ain't going to happen very often on a day trade. And you know what I would say to you, Dick, is back it up. Okay, the one way to really get yourself screwed up in the marketplace is to make an assumption. Now what Dick said, he says, here's the rub. If I take 80% of my winning position off of 23 pips, at what price does the remaining 20% have to close out at for an average win of 75? Like I said, figure it out. You know, and he says, hint, it ain't going to happen very often on a day trade. Now, first of all, I'll deal with two things. Number one, you didn't do any work. All you're doing is you're saying it ain't going to happen very often on a day trade, and you don't back it up. Number two, what I discussed in the video was leaving a position on that may be on for several days. Okay, so you need to go back and pay attention to what I said in the videos. And you need to go back and do the work. If you're going to write me and say something like this, you've got to back it up. In fact, most of the people who've written me about you know, these types of scenarios make big assumptions about the marketplace that just aren't true because they haven't done the work. Anyway, he goes on, if you're taking 80% of your position off at less than your stop loss, then I would say that your winning percentage, in fact, is hugely important. Basically, what Dick is saying is if you are deviating from your system, then your winning percentage is hugely important. And that's exactly what I said. Again, you need to pay attention, Dick, when you're listening to what I'm saying. And what I said in that expectancy scenario was that how you trade the system is absolutely vital. That was the point of the expectancy section. Okay, so it wasn't that I have unreasonable expectations. My expectations are based on what the market gives me. It's based on what the market has actually done, not that I'm projecting out in the future. And what I would challenge you to do is go back through the daily videos and you see where the results would have been and come up with your own average, and then email me and tell me that I have unreasonable expectations. But don't just send me an email telling me you think I have unreasonable expectations without backing it up. Okay, next question. I have never traded anything. I'm completely ignorant about Forex. Well, let me help you out.